Hi there, welcome back. And we told you that spinning tops and dojis are also candlestick formations. And as the name suggests, we talk about spinning tops first. So these are basically candlesticks that can be literally spun around their bodies because they have a very small body. They have a long shadow on top and at the bottom. And that's how they're characterized. Let's see what they mean in terms of chart behavior. Spinning tops first, Doc.
See, spinning tops are characterized, like you said, with a very small body. Now, what does really a small body mean? It means that the market could not move a big distance between the opening and the closing prices, which would suggest that, bulls and bears are evenly matched. So whenever you have small body candles, it actually indicates a very high level of indecision. Now, a spinning top in particular, like the one which you can see here, is actually characterized by A, a small body, and B, two long shadows on either side. Now, this entire picture shows one of very high level of indecision. And when you see it at the end of a long advance, you don't really want very high level of indecision at the top. If you do see it there, what it actually indicates is that the market may be in danger of running out of the trend strength. So spinning tops coming at the end of advances are very, very tricky things which you should be very alert for because they are indicative of potential change in trends. And
the doji, would that also be indicative of the end of a trend?
I think the doji is like an even stronger sort of indicator of a change in trend. If you look at the chart of India Glycol, which I have on here, and I have had it marked here, it's not very different from the spinning top pattern, right, which I had shown you earlier. The only difference being that the size of the body is even smaller to the point of being non-existent. The most ideal doji is where the opening and closing is the same. So you just have it, as you mentioned, like a cross. But you also get very, very small micro-sized bodies which will also fall within the ambit of being called as a doji. A doji coming at the end of an advance is certainly a killer pattern. It says very definitively that the uptrend is over. And one must be very, very wary when a doji comes at the end of any advance as well as a decline. The doji works at both ends.
As always, our favorite question is when does it not work and how often is that?
Expecting a big move to appear out of every candlestick reversal pattern, be it a doji or be it a spinning top or a hammer or a shooting star, etc., that would not be correct. So you have to place it in a little bit of perspective. And if you see it on the chart, what you would actually get is when a bottom formation is in progress, you will actually get several sets of candlestick patterns. Now you see this is a big decline and then you have something like a spinning top type pattern, or a hammer which is here, and then it gets succeeded by yet another hammer. Then you have another sort of reversal pattern here. So none of these really produce large moves. But if you get attuned to thinking that every pattern will produce a large move, then really the problem lies with the user who sort of misunderstands or places extra value on every pattern.
So can it be a prime trading tool, or is it just a confirmatory tool?
It cannot be a prime trading tool because it's a charting style. It's not really a trading tool in the sense of the various things we described, like your moving averages and your RSI, ROC, etc. Those are very specific trading tools, whereas candlestick is a charting style. Within that, it has got more elements which give you more clue. But like anything else, it has to be combined with more things.
So to make it more interesting. The next question really is that if you wanted to combine it with some other patterns, how would you actually do it? Because clearly, as you said, it's supposed to indicate reversals, and reversals need a lot more to confirm because they are also more risky to trade because you're trying to, you expect the trend to reverse at that point of time.
Yeah. So what you need to do is place candlesticks in some sort of a support resistance perspective. Support resistance, as we have discussed, is one of the cornerstones within technical analysis, and everything emerges out of that. Now, if you look at the chart of India Infoline, which I have on here, and what you will see is that the prices are meeting the previous high out here, and as you go into the previous high, when you reach into resistance, as it were, the previous high is a resistance, what you develop here is a long reddish candle. Red indicating that there is some amount of selling. So when you combine the resistance with the reddish candle or the bearish candle, that indicates that this up move which is trading up into resistance is likely to meet with some amount of problems. Similarly, the next time around, it again trades up into the same resistance. It trades in with a lot of confidence, but the very next day it gets slammed down. So the concept of resistance is there, but it gets enhanced by the fact that there is a green candle or a red candle around it. Right. So
just on this chart,
perspective.
staying with this interesting chart, there's one point on the right, extreme right, which is higher than the resistance levels that we had earlier. If we were to join that dot with the second high, you'd actually get an upward trending line.
Yeah.
But instead of that, you choose to look at this horizontal resistance level line. Why is that?
The horizontal is something I have used first to illustrate the fact that these two levels, how the change from the green to the red actually made sense in the context of your resistance. Now that three tops have got aligned at the same level, I think that this is a very significant level of resistance. So I just project it out into the future. At the same time, if I look at the lower level, I have a rising trend line here, a support trend line, higher bottoms, and look at the way the chart actually interacts, the prices actually interact with the trend line. As you reach down into support, what you're getting is long body green candles. So this is what I meant by placing the candlestick in the context of support resistance pattern.
Where it works very well. There's another one that you've said, Doc, and which is on the India Info Line chart, where you can actually use some other signals as well, along with the candlesticks. Yeah,
I mean, here I have not included it, but then you can actually add your oscillators here. You can add your, let's say, moving averages here. I have used the trend line as a concept. You can see that as a pattern. This is something called as an ascending triangle. Right? And in the triangle now we are having an upside breakout here out of a triangle. An ascending triangle is where you have a fixed line of supply and a rising line of demand. It's a variant of the triangle pattern we spoke about in earlier episode. Now we have a breakout out of it, and it's actually telling us that India Info Line at this juncture is exceeding resistances and doing so with fairly nice looking bullish candles.
Okay. Before we head out, here's a small question that we have for you, and there you have it on your charts. Really, the question is whether technical charts are meant only for the short-term trader, or are they meant for the long-term trader as well? So, true or false, whether technical charts are meant for short-term traders? Think about that. We'll tell you when we come back.